finance can be so confusing. It is difficult to understand the difference between commercial and investment banking, between the Big Four advisory firms and consulting firms, between corporate finance and investment finance. Terms like post-merger integration, commercial lending, credit analysis, assurance, forensics, and private equity could lead you to believe that this is a super complicated area that you will never understand. But it isn't. It's a fairly logical, clearly structured, and fascinating field. And by the end of this video, you will have an idea about who does what in the world of finance. We'll cover a great deal of information in a short amount of time, but our schematic approach will make things clear to you. The best way to understand the finance industry and the different roles in it is through a practical example. We'll describe how different finance professionals can help a company throughout its life cycle. Naturally, a company needs to evolve in each stage of its growth path. Therefore, professionals with a different degree of specialization must be involved. What we'll do here is go through the stages of the company lifecycle model and describe what happens in each of them, giving an idea of why the company needs to hire finance professionals in-house or work with an external firm providing specialized financial services. The lifecycle model is straightforward. A company could potentially go through several stages throughout its life: startup, growing firm, enterprise, large enterprise, and distressed firm. If we have to depict its revenue development during each of these stages over time, most typically it will take a similar shape to this one. A startup company doesn't have many sales. Its major goal is to validate the product and verify the business model. Then, if all goes well in terms of product development and product market fit, revenue increases quickly, within a few months, as the company transitions into the growth stage. Typically, during this period, the business needs additional resources to invest in production, working capital, and a growing personnel cost. After a couple of years, or less, the firm becomes a profitable enterprise with well-established processes, aiming to improve operational performance and efficiency while competing for market share. Eventually, solid management could allow the enterprise firm to most likely expand overseas or further penetrate its domestic markets, and hence become a large enterprise. Seeing how a startup gradually becomes a large enterprise is a beautiful thing. But first, it takes a great entrepreneur and excellent management team to get there. And yet, as it frequently happens in life, things don't always go as planned. Sometimes organizations face adverse external conditions or experience internal turmoil and make the wrong strategic moves. So we must say that the decline phase is a possibility too. Of course, a distressed firm can either go bankrupt or turn things around, back to the enterprise or large enterprise stage. Sometimes distressed companies make for good acquisition targets by other large firms because of their low price at that given moment. A managing director at Goldman Sachs once referred to this type of deal as buying weakness. To depict all of the concepts we want to discuss and have clear structure, we created an infographic which summarizes the different types of financial activities and operations a company might encounter throughout its life cycle. Some of them happen internally, inside the organization, while others externally. These are interactions with entities providing different types of financial services. This is the first main distinction we can make. As you can see, horizontally the infographic is divided in two main parts: internal and external activities. Vertically, they'll have the company lifecycle stages. In each of these phases, a company would need to perform different types of financial activities and use different types of external financial services. All right, let's start with our example. So, at the beginning of our story, we have an entrepreneur who wants to open a fashion company. Francesca is Italian, holds a business degree from the United States, and naturally has impeccable taste. Moreover, her close friend Fabrizio is a talented designer. One summer evening, when both of them are in Milan, they have an animated conversation over dinner about a company that sells accessories and shoes for modern women. The very next day, full of enthusiasm and hope, Francesca and Fabrizio filed documents to register a legal entity called Borse and Scarpe. As the French philosopher Albert Camus said, "Great works are often born on a street corner or in a restaurant's revolving door." This was certainly the case here. Of course, building a business is an expensive endeavor. Luckily, Francesca and Fabrizio have some savings and are able to contribute 50,000 euros each. The sum serves as the initial equity needed to fund their new firm, of which the two partners will own an equal share. As for the actual process, the initial plan is to start by focusing on 3 key aspects. Find a factory, work on the first line of bags, and raise funds from investors. Francesca traveled to the south of Italy to find suitable factories willing to work with a startup company and are open to accepting relatively small initial orders. Ideally, they would have helped other brands create their prototypes in the past. Meanwhile, Fabrizio stays in Milan and works on Borse and Scarpe's first line of bags. The strategy is to start with only one product line, producing bags only, then gradually expand the firm's portfolio when they have the necessary resources to do that. Speaking of resources, Francesca is convinced that the company needs to raise funds from investors because the €100,000 initial capital is not sufficient to cover all the production costs, traveling expenses, salaries, and the marketing costs that will have to be sustained. For this reason, she's eager to find investors who are willing to finance early-stage businesses in the fashion industry. In other words, Francesca is looking for a venture capital VC firm to bring on board. The first few meetings Borse and Scarpe have with VC funds are not successful. As a result, Francesca decides to talk to a commercial bank and see if they'd be willing to finance them with a loan. A common practice when a small company applies for a loan is to seek financing from an external source. This is where the firm's first interaction with external parties happens. Francesca will have an exploratory meeting with a credit analyst, whose role is to assess whether the firm is a reliable borrower. Francesca makes an appointment at a local branch, where she schedules an interview with one of the bank's credit analysts. Usually, during such a meeting, the lender would ask a number of standard questions. "Does your business generate a positive cash flow?" was the first item on his list. "We don't have any revenue, so I don't think we do," Francesca replied. "Does your business own tangible assets, land, properties, buildings, or equipment that can be used as a guarantee you'll repay the loan?" The credit analyst continued. "No, we don't. All we have is our limited savings and a mutual desire to put this business in motion," said Francesca. "Of course, I understand," nodded the credit analyst. "In that case, do you think that there's a wealthy person, perhaps a friend or relative, who will be willing to sign as a co-guarantor so that we can take recourse against them if you are unwilling to repay the given loan?" Francesca smiled and replied, "I'm not sure we can ask such a gesture from someone. We don't want to put anyone at risk." "I understand your position. However, in this case, I must say that it is very unlikely that we'll be able to finance your business. We don't have any sort of collateral to ensure you'll pay us back." Without elaborating further, the credit analyst meant that a commercial bank typically needs a high degree of certainty that the borrower will be able to repay the loan. The bank tries to identify good borrowers, lend them money, and charge some interest on the amount they have lent. That's their business model. Francesca nods in gratitude for the meeting. She understands that commercial banks don't give money to small companies without any assets that can be pledged as collateral. But at the same time, she feels desperate. A few weeks go by, and the two friends have to spend money on several occasions: train and taxi tickets, dinner, hotels, sketching boards, legal expenses. So, to put everything in order and track all types of costs, and hopefully revenue in the future, Francesca and Fabrizio realize they need to hire an accountant. Since they can't afford a full-time professional, the two hire an external accountant who deals with the administration of several small companies, charging each of them an affordable, fixed monthly fee. As luck would have it, the accountant is also very well connected with different VCs in Milan, Many of the small companies he has worked with in the past have needed early-stage financing as well. So, after learning of their current situation, the accountant introduces Francesca and Fabrizio to a promising venture capital firm, specializing in Italian fashion startups. The VC investor greets them with open arms. "You are in luck. A few days ago, we launched our company's latest fund," he says. "We raised 40 million euros from several financial institutions and wealthy individuals. Our goal is to find sustainable investment targets in the fashion and consumer goods sectors over the next 18 months. As you know, our VC firm specializes in fashion. The average investment we're looking to make with this fund is 1 million euros. However, you'll need to send us a solid pitch deck, and please make sure to include some numbers. This would help us to assess the feasibility of what you're trying to do." At the end of the meeting, Francesca and Fabrizio feel encouraged and slightly intimidated. VC firms screen hundreds of applicants, and nothing short of an excellent pitch deck will allow the budding entrepreneurs to acquire the much-needed equity financing. Ultimately, Francesca takes matters into her own hands. Thanks to her business studies, she knows how to prepare a pitch deck and what investors want to see. An explanation of a problem people have and that the company is trying to address, as well as the solution and an estimate of the market size. Finally, investors want to know what differentiates the firm's products from the ones offered by other companies. In the last slide of her presentation, Francesca indicates that Borse and Scarpe are looking for a 1 million euro investment, which would be sufficient for the next 12 months and allow the company to reach a revenue of around 1.5 million euro. According to the Roman philosopher Seneca, luck is when preparation meets opportunity. And in this case, we can say that Francesca and Fabrizio got lucky. They received the financing. This wouldn't have been possible if Fabrizio didn't impress the investors with his understanding of the target market demonstrated in the presentation. This, in combination with Francesca's business preparation and drive for success, convinced the VC firm that Borse and Scarpe is a company worth betting on. The fresh funds meant that Fabrizio and Francesca will be able to hire a few people in their startup and put their plans in motion. In addition, the two co-founders, also now co-CEOs of the company, stipulate a contract with one of the factories Francesca found in her initial research. While it isn't the cheapest choice, it offers great quality at an acceptable price. After a number of iterations with sample bags and extensive conversations with focus groups who tried the samples, Fabrizio gives the green light for the factory to produce 10,000 bags of the firm's first model. And so, Borse and Scarpe have a product to sell to their clients after all. Francesca and Fabrizio initiate their sales efforts, recruit a few more people to help with production, accounting, and general administration, and towards the end of the year, feel very optimistic and satisfied with how things are going. At a certain point, the VC fund calls to inform the two business partners that they need to provide an audited financial statement at the end of each year, standard for all portfolio companies in which the fund has invested. The firm's relatively small size means that the audit would be done fairly quickly, and in this way, the VC fund and its investors could rest assured that the financial statements have been verified by a reputable audit company, as Francesca and Fabrizio were advised to hire one of the Big Four auditing firms, KPMG, PwC, Deloitte, or Ernst & Young. According to the VCs, their services are more expensive than those of smaller audit firms, but their stamp of approval will mean more going forward. As a result, Borse and Scarpe hire one of the Big Four companies as their auditor. Over the next year, the company's business continues to grow. Several new lines of shoes and bags enter production. Retail clients and wholesalers indicate that women love Borse and Scarpe's high-quality, modern-looking Italian products. What is more, often the sales team can't fulfill client orders as they are out of stock and don't have sufficient funds to reorder at the time. Francesca and Fabrizio become aware of one important trend. The more the business grows, the bigger their capital needs become. Think of our working capital as the following equation: inventory plus trade receivable minus trade payable, Francesca tells Fabrizio. Inventory eats up working capital. So does the money that we ought to receive from clients but have not yet received, otherwise known as accounts receivable. We are able to partially offset this by delaying payments to suppliers. Fabrizio nods, then says, "But we can't stall payments to the factory because they're a family business and rely heavily on us to pay their workers." Exactly, Francesca agrees. So, the more our business grows, the more inventory we will need, and the more money will be locked with wholesaler clients who will delay their payments. Both of them know that it is time to raise an additional round of financing from VCs. The good thing is that this is precisely the situation VCs want to be involved in. A fast-growing business that is capital-hungry with bold founders who are willing to ask for additional funding. To avoid diluting their initial investment, the VC fund, which provided the so-called seed financing to Borse and Scarpe, offers an additional €3 million sum rather quickly. They called this round a Series A financing. Francesca and Fabrizio mean to use the money for working capital needs, as well as to expand their team with marketing, sales, logistics, and finance personnel. In terms of finance and accounting, the situation has now grown outside the external accountant's comfort zone. Various requests now require more time to be executed. Moreover, Francesca doesn't feel comfortable operating without having clear visibility on profitability margins, growth rates per product, and the development of various types of costs. Hence, it becomes clear that hiring a finance manager is necessary. The manager will then have to recruit a team of 3 people. A full-time internal accountant to replace the external accountant working part-time, a financial analyst to study revenue growth, profitability, and volumes sold to different cities, a treasury specialist to monitor cash flows and handle invoicing. Ideally, the newly hired finance manager will put everything in order and introduce some best practices when it comes to each of the activities carried out by people in the finance team. Over time, as the firm's business grows, this solid foundation will help build a profitable company by providing data to facilitate decision-making and keep executives' focus on profitability margins. A few months after receiving the second round of financing, Borse and Scarpe receive a call from their commercial bank. The firm now qualifies as a premium banking client. In essence, premium banking is a service designed for wealthy and promising clients, the corporate banker explains. Some of the benefits for the firms involved are the ability to contact a personal relationship manager, priority handling, and bank products and services under special conditions. This is an interesting invitation. We should go and meet them, Francesca tells her finance manager. A few days later, they schedule a meeting, and Borse and Scarpe are assigned their first corporate banker, who is eager to learn more about the company and lay the foundations of a long-term relationship. Once he understands what the company needs, the banker explains that naturally the bank isn't interested in an equity investment, which means buying a portion of the firm, but would love to support the business through other debt-type services. For example, a revolving loan for working capital, a product which, similarly to an overdraft, offers funds depending on the firm's needs throughout the year. Essentially, when Borse and Scarpe's clients pay their invoices, money would be repaid in the revolving loan account. In addition, Borse and Scarpe's private banker offers to help in case the company decides to buy its own real estate locations in order to build flagship brand stores. This topic hits a soft spot for Francesca, as she has always dreamed of building a fashion business strong enough to afford its own locations in urban centers. She nods and says that they will have to follow up on that once she has a conversation with Fabrizio and their investors. On the way back, Francesca sits in the car and thinks about the private banker's suggestion. How fantastic it would be to see Borse and Scarpe on a storefront while on a Sunday walk in the city center. But then she turns to the finance manager and asks, "How is everything coming along with the finance team? Are you happy with the progress that you've made?" The finance manager doesn't answer immediately. Instead, he takes his time to reflect and provide accurate information, I think we are almost there. It's just that there appears to be some confusion between the financial analyst and the treasury specialist. There were a few situations when it wasn't clear who should be doing what. To fix that, I provided some very narrow guidelines. The treasurer should monitor incoming and outgoing cash flows, prepare a forecast for the firm's 7 and 30-day cash balance, ensure payments to suppliers are sent in a timely manner, and track receivables from clients, as well as following up with them when necessary. On the other hand, the financial analyst is expected to study all drivers of profitability, volume, sales prices, revenue, disaggregate different types of revenue, costs, monitor the nature of expenses, study profitability per product, forecast demand, and work with me to prepare a budget for future periods. This is how we've divided our work at the moment. I think we're in a good place. Francesca nods and thinks to herself, indeed, and what an exciting place to be in. In the following year, the business continues to grow. New product lines come out, which help reach even more wholesalers. Borse and Scarpe established themselves as an up-and-coming brand, with very positive reviews from critics and trendy influencers coming in. Revenues are expected to surpass 15 million euros, with a solid EBITDA, earnings before interest, taxes, depreciation, and amortization profitability of around 25%. Unsurprisingly, however, working capital continues to be an issue, and the company has to pay significant interest expenses on the revolving loan provided by the bank, which drains financial resources and lowers bottom-line profitability. In addition, Fabrizio and Francesca establish that they need fresh funds for 3 projects that keep resurfacing in their discussions. 1. Buying a firm that specializes in eyewear or perfume production. 2. Internalizing production of certain items in-house. And 3. Investing in flagship brand stores in central city locations. We'll need 50 years to save enough money for each project, and that's excluding our growing working capital needs, Francesca says. Fabrizio, in turn, reasons with his business partner. Well, we certainly can't wait 50 years, can we? Heck, we can't wait even 2. Our competitors will be miles ahead. So, what can we do? Let's talk to the VC guys and try to raise additional capital. I agree, Francesca nods. We need fresh funds to accelerate our growth, and the time is right. A few days later, Francesca and Fabrizio meet with their main contact from the VC fund. He congratulates them on the success the business has had, stating that they were one of his favorite portfolio companies. There is some bad news that follows. Unfortunately, the VC fund wouldn't be able to participate in Borse and Scarpe's next investment round, as it is significantly outside the admissible deal size range. Currently, your company is growing very rapidly, and with an annual revenue above 15 million euro, it should be valued in the range between 100 and 150 million euros. You're looking to raise capital in exchange for 20% equity in the business, which translates into a financing check in the region of 20 to 30 million euros. This is great, but unfortunately, it is outside our range. Our investors have given us a mandate to fund early-stage companies, and we can't concentrate this many resources on one business. While we'll prefer to hold our shares with you guys, we wouldn't be able to provide financing this time, the investor concludes. He follows up with a recommendation of 2 private equity funds he can put the business partners in touch with. Francesca and Fabrizio gladly accept, expressing serious interest. However, both provide a valuation that is not only on the lower side of the range indicated by the VC investor, but even slightly under. According to the 2 funds, the company is worth 85 and 95 million, respectively. Francesca and Fabrizio realize they need professional advice. After all, a specialized advisory firm that can help them raise money at the right price would create a lot of value in a large transaction.